Good morning, everyone. I have to say, it's a privilege and honor to be here in Toronto, but it was a bit of a rough road. I'm a diehard, lifelong Milwaukee Bucks fan, so there's that. And then last night, when I arrived, I got a call from my wife that my daughter was in the ER with a concussion. So I was up late waiting for news on that. She's fine. And then this morning, when I was dropped off by the taxi, it drove off with my cell phone in it. So I chased it, actually got my cell phone, but it's been a bit of a rough road getting here. So I'm happy to be here. And I do want to take care of a few housekeeping matters, too. First of all, the Blakes, we're actually a pro bono client of the Blakes in Montreal. And so it's great to be in this venue, but also they've done a lot of terrific work for us. So I just wanted to give them a shout out about how they've helped us in setting up PERC Canada. And then secondly, to TransUnion Canada generally, but Matt Fabian specifically, this project has been over a year in the works. And it really only got traction when Matt got involved and got into the trenches and started working with the data team and figuring out the methodology and how to operationalize it and get us what we needed to deliver this content to you all today. So thanks to Matt and to you. Now, with that aside, the findings here today are PERCs. They're not TransUnions. We're independent. We're not a consultancy that starts with the conclusion and backfills. This is our own interpretation, so we may not necessarily agree on every reference point, but again, it wouldn't have been possible but for the data and some of the analytics that TransUnion contributed. So, with that said, there we go. Just a little bit about PERC and PERC Canada. PERC was founded in 2002. We're the only think tank on Earth that's exclusively dedicated to the relationship between economic outcomes, primarily financial inclusion on the one hand, and the responsible use of information and information solutions on the other hand. So this has led us to a lot of interesting work in places all around the world with a very diverse group of supporters. So generally speaking, we have foundations that support us, so the Bill and Melinda Gates Foundation, the Rockefeller Foundation, that sort. Non-government organizations, World Bank, IFC, CGAP, different regional development banks, and so forth. Internationally, there are multilateral organizations and like APEC, and we run an Asia Pacific Credit Coalition and do quite a bit of work for APEC in that capacity. U.S. government, we're about to release a study on rent reporting with the U.S. Department of Housing and Urban Development. And I don't know how much people follow American politics, but HUD Secretary Ben Carson was recently chastised for confusing an Oreo with a cookie. In that same presentation, he actually referenced our study. So we were kind of overclouded by his ignorance, but nonetheless, that's coming up. We're a partner. We're actually allowed to say we're a partner with the CFPB, which is good. Different industry trade associations, primarily tech, financial, and data. And then, of course, the private sector, and again, unsurprisingly, tech, financial, and information services companies. We've done work. We need to do a project in Russia, so if anybody can hook us up with that, because that would nicely fill in the map. But otherwise, as was mentioned, we're 5 continents, and these are places where we've actually been in the trenches, done field work, had a product that was presented either to different stakeholder audiences. So it's been great because it's given us an opportunity to have a real comparative framework when we analyze situations or scenarios in a specific country. So we're asked frequently, why do we focus on credit data? It seems really narrow and a pretty small slice of financial services. And the reason being that in a modern economy, underwriting is now automated. And therefore, the contents of your credit report are incredibly important to your life and life's chances, particularly because of the growing number of applications. And also, therefore, the algorithms, the scores, the models that are used to assess that data and evaluate you as an outcome, whether it's your probability of default and being 90 days late in a year, responding to a marketing offer, profitability, et cetera. This is very determinative. And credit, access to credit is important because, as we know, and particularly in the wake of Tomasz Piketty, asset building is critical, not only to you, but to your the subsequent generation. And the two primary means by which individuals in Canada and anywhere build assets are, one, home ownership, and two, owning a small business. And for most people, that requires convincing someone, usually a bank, to give you money to do that. And that means your credit file comes into play again. So, this is fundamental to asset building and wealth creation. So, credit invisibility. Very interesting. We came to this in the States, 16 years ago, when the Fair and Accurate Credit Transactions Act was passed. And Congress mandated to the Federal Trade Commission to look at the question of whether there was data out there that wasn't in conventional credit files or credit reports that, if included, would increase financial inclusion. And if so, what? And if so, who would benefit? The FTC did a very rudimentary job. They don't like doing research for Congress. They're an enforcement agency. They said, yes, there's data out there. No need to act. The market will take care of it. We weren't very happy with that outcome. And this began what is now a 15, 16-year endeavor, what we call our Alternative Data Initiative. But the premise was basically this, that there is a non-trivial population in the most data-rich environment on Earth that are unable to access credit because of insufficient information for lenders to assess credit risk. And that there are data assets out there that, if brought into the origination process, would make lenders see them differently. And so we wanted to say, well, what are those data assets? How do we prioritize them? How achievable is this? What are the barriers to bringing them into that process? And that's what brought us to our understanding that, there are perceptions. One of the barriers is there are misperceptions about the credit information sharing system in the U.S. and here in Canada and other countries. In the U.S., we say we have a voluntary system. We say that it's comprehensive, meaning multi-sectoral, and we say that it's full file, meaning that you've got timely and late payment data. In fact, the U.S. is a hybrid system, like most countries. It's partially multi-sectoral. There's bank and non-bank data. Bank data, regulated lender data is full file, positive and negative. However, the non-financial payment data is grossly underreported and is overwhelmingly just negative data. And when you're populating an information database with either positive only or negative only, it could distort or degrade the integrity of that data in terms of assessing risk. And more importantly, you're putting negative data in for people who that might be their only trade line. And then a credit file, instead of being a tool for inclusion, becomes a tool for exclusion. It becomes a blacklist. And we've seen this, there are a number of countries that we were active in, most recently New Zealand and Australia, where that's all the data they had. They had only negative data. And it became very difficult to access credit for many people. Credit was contracted, was very expensive, competition was diminished. There were many negative outcomes that were overcome with the inclusion of positive data. So the stakes here aren't just financial inclusion, they're also competition, and they're sort of interdependent, and we'll see how that plays out in the context of Canada later. So, bringing this to a more narrow focus, we wanted to take the model that we developed first in the US and apply it here, thinking that there are a lot of analogs between the two markets, and we suspected ex ante that the patterns would be similar. So we were looking at, is there a credit invisible population? If so, what are the contours? And then is the solution that was available that we advocated in the U.S. available here? And then look at basically what are the consequences if in fact there are credit invisibles, and if in fact there's an undersupply, what does the lending landscape look like? So starting with who are they in the U.S. for comparison? Generally speaking, the credit invisible population are comprised of lower income persons, members of protected classes, i.e. minority communities, younger persons, millennials, credit inexperienced, elderly persons, which was a surprise to us. We actually didn't know that until we did the analytics. So think of the increasing frequency of late stage divorce, widow-widower effect. The credit history could be concentrated in typically the widowers. The male's history, he dies, and the widow needs a home maintenance loan, but she's credit invisible and can't get it. So this was a pretty significant finding. And then immigrant population, legal immigrants, newer persons. My wife immigrated from Sri Lanka and was constantly yelling at me that I couldn't get her all kinds of credit when she had no credit history, and that she had to rely on me as a co-authorized user. So there's that. Now, how do we solve credit invisibility? We thankfully did the analytics on this in terms of what is the purpose of the alt data? The alt, it's driving financial inclusion for credit invisibles. How do we rank order it? And we looked at basically what we call our 3 C's of alt data. It was, is it credit-like versus cash-like? The coverage of the credit invisible population, and then from business process perspective, the concentration of the industries. And so we prioritized with a sort of binary rating. If it's credit-like, it should be higher priority. If it has higher coverage, higher priority, and if the industry is more concentrated, therefore it's easier to acquire relatively also. So we ended up with basically prioritizing energy utility payment data and we'll say media payment data. That includes broadband, satellite, cable TV, mobile and plain old telecoms network data. And this is basically that chart that sums it up. And this is why we focused our attention on empirical analysis in those areas. So basically what we found is this, that when you add non-financial payment data to credit invisible population, the distribution of risk mirrors the general population, the thicker file population, but for superprime, meaning that you don't go from credit invisible to an 800 plus credit score. But what that does suggest is that for a non-trivial portion of the population that are financially excluded or credit underserved, there's a large number of those persons who are actually a very good credit risk and who would, with this information, qualify for many variants of prime forms of credit, not just low-limit cards. There are real opportunities here. And importantly, from a policy optics perspective, because there is a policy dimension to this, that the largest net beneficiaries are disproportionately from underserved communities. They're lower income, members of minority communities, immigrants. So this is quite significant in terms of an ability to effectuate change from a policy or regulatory perspective. So the first quantitative analysis we did on this, and this was quite an undertaking. For those who are in the credit bureau space, we actually had Experian, Equifax, TransUnion, and FICO working together on this pre-Vantage score. They rarely work together. So this with, we had Bank of America, GE, JP Morgan Chase, Hennie Mae, some of the GSEs. This is a huge it was like the Manhattan Project of alt data. This was, unfortunately, 2007. Obviously, the events of 2008 sort of shifted everyone's attention a bit. But in 2007, this was a very hot topic. And the reason being that we did terrific analytics on 10 production risk scores. So generic scorecards, thin file scorecards, bankruptcy cards, even mortgage routing cards. And the net result was incredibly promising. We had Bank of America stand up and say that they were looking at enterprise-wide applications and they were going to give partial treatment to TransUnion because TransUnion had the largest database of alternative data in the U.S. at the time. And Experian and Equifax were in the room. Obviously, hearing that made them want to prioritize this. We had General Electric stand up and say that they felt that 40% of the credit invisible population would qualify for existing products, and they were aggressively pursuing this. FICO rushed to the market their exchange scoring model because of this, because the market was heating up. There was tremendous interest. Actually, had Sheila Bair, who was then the chair of the FDIC, invite me 2 weeks after we debuted this at the Brookings Institution to her office saying, we're fully committed to this. We're going to help you, make this happen. Then 2008 happened, and this was pushed off of everyone's radar screen because folks were in survival mode. We've done, by the way, quite a number of studies in different contexts. They're all freely available at www.perc.net. I would encourage you to go and peruse and download. This was a study we did for the American Chamber of Commerce Japan, Japan has a very fragmented system, third largest economy on earth, incredibly dysfunctional credit information sharing system. So 25% of all loans in Japan happen on a black market. There's actually an industry in the yellow pages in any major city where the midnight movers. Midnight movers are if you have credit problems with your informal lenders, they come in the middle of the night, pack you up anonymously, and make you disappear. Because the alternative lenders in Japan have very interesting collection techniques, which I don't advise. But what we found in the context of Japan was that more robust, comprehensive, full-file information sharing through private credit bureaus results in significant and sustainable growth and lending to the private sector as a ratio of GDP. That's a mouthful. But this is something that's been borne out in other studies. There's a famous one by Jankoff, McLeish, and Schliefer, multi-country, multivariate regression analysis showing the same thing. Basically, the more data you have the more predictive data you have into the system for decision making, the more you are able to differentiate between good and bad, the more lending that happens. So this is important for MSMEs, this is important for individuals, it puts into effect all of these positive, virtuous economic cycles. In addition to sort of highlighting the fact of credit invisibility, and by the way, probably the biggest contribution that we, PERC, as an institution, have made to this policy issue area isn't all of the quantitative analysis we've done. It isn't all the massive tens of millions of files and production models and so forth. It's just coining the term credit invisibility. It caught on. Bills were introduced in Congress about credit invisibility. The CFPB picked up the term and started producing studies on credit invisibility. And that meant that once it's in that vernacular, it's actually an official problem. And once it's a problem, it needs a solution. So it's that meme actually is a pretty significant contribution. So another one, we're sort of hopping on that meme bandwagon, and we didn't invent it, but it's underused and underanalyzed, is the notion of credit deserts. There's not much out there, you'll see, on this anywhere. There's some sort of qualitative analysis on banking deserts, which are sort of different from credit deserts. But we define credit deserts as where you have an above-average concentration of credit invisibles, an above-average concentration of fringe financial institutions, which are what we call high-cost lenders. So think payday lenders, pawn shops, rent-to-own, title lenders, et cetera. And then lower than average household credit scores, and then income. Below average income, although we found that's not always the case. So credit score, income, fringe financial institutions, and credit invisibility. Now, we didn't, all of this has been borne out in research by different sources. In particular, the GAO and the Fed have done terrific research on this. So these correlations have been shown to exist. Nobody's ever put them all together, and no one's ever put them all together visibly in an information map. We got a grant from the Silicon Valley Community Foundation, famous last year from getting, I think, $1 billion from Zuckerberg, which is a nice endowment for a community. They only look at two counties, San Mateo and Santa Clara County, which comprises Silicon Valley. So you think Silicon Valley, extremely wealthy, lots of data epicenter of the universe. There really shouldn't be credit deserts. But what we found, in fact, was that even in Silicon Valley, there are pronounced credit deserts where we're looking at over 20 and even approximately 30+% credit invisibles, which is astounding. And they're not in low-income neighborhoods exclusively. Now, of course, the cost of living in these two counties is astronomical. So if you're earning $75,000 US, that's tough. It's tough to live in those areas with what is, by most measures, anywhere else a very decent income. But so what we also did that went beyond the earlier analysis was we said, well, let's add a solution to this. What happens to this area? What happens to these variables when we populate credit files with non-traditional data, alternative data? And we rescore the population, and we show these, and you see now these sort of barren, parched, yellow credit deserts are transformed into lush green credit oases. And this is a very compelling visual, and this is the kind that we like to take to policymakers because they can make that connection. Now, we have this, many more visuals in terms of the presence of fringe financial institutions, the presence of mainstream lenders. But what we believe to be true is that the more data that's available to lenders, and the differently they are able to see these populations, it will actually change the landscape where they will be competing with fringe financial institutions. There will be more robust competition among the existing FFIs and existing mainstream lenders, or more recently, it will enable competitive entry for fintech companies that are offering a product that is not a traditional FFI product, that is in direct competition with the mainstream lenders because they're ignoring these communities. And so we expect to see a diminution of fringe financial institutions and a population of fintech and or traditional lenders. And this is also significant because this is cast against a backdrop of mainstream lenders closing thousands and thousands and thousands of branches nationally in the wake of the great financial crisis of 08-09. So now, that's all by way of context. I did want to suggest that the findings we're presenting today are preliminary. This is our first foray into this issue. Our objective here is to open eyes, raise awareness. When we first began the exploratory phase of this analysis, we talked to a number of stakeholders, and we're pretty astounded by some of the preliminary responses. One senior executive from a large financial entity said that there were no problems with credit access in Canada, that there's data on everybody. Anybody who wants credit can stroll into a bank and get it. It's that simple. Okay. It's an empirical question. Maybe that's true. I mean, it would be very different from our experience in the entire rest of the world, but I'm willing to see that there's exceptionalism in Canada. So we also, had to set up a methodology. There's some different data restrictions here than in other markets, but generally speaking, the type of analysis that we just, sort of ran through quite quickly for the U.S. I mean, I think I summarized 15 years of research in as many minutes. We applied here. What is the profile? So young Canadians, there are roughly 400, 500,000 million people entering the credit market every year in Canada. And why does this matter? I mean, that's always been the case. There have always been people who turned 18, always been people who graduated college. Millennials eschew traditional credit at a rate that's unprecedented. And primarily because there are more options now. There are more payment systems and mechanisms for moving money and storing money, et cetera, that were unavailable to my generation or my parents' generation. And so that means that there's just not as much data on them as there were on previous generations of sort of the new to credit cohort. Immigrants, like most countries that had a pig in the python, the baby boom population that are now entering retirement, it's straining the social security, social safety net, and there's a need to prop that up with a more flexible and permissive immigration policy. So the rate of immigration and the number of immigrants is increasing in Canada, and it's sizable relative to the general population. Canadians who live more than 120 miles from the 49th parallel also have not as much access to traditional financial services as others. And then, the underserved, the traditional underserved populations, low income, members of protected communities, and so forth. So this is, where we see the credit invisible concentrations, and it's very much akin to the sociodemographics of credit invisibility in the U.S. Significantly, despite the proclamations of the unmentioned gentleman who said there are no problems with credit access in Canada, that doesn't fly in the face of empirical evidence. If that were the case, we wouldn't see substantial growth in fringe financial institutions. Payday lending, which is just one aspect of this, has been booming, even though it's heavily regulated, and it's more regulated than in the U.S. in terms of the rates that can be charged, and also debt ratios. Canada has the dubious distinction of having the highest ratio of debt to income among the OECD countries on a consumer level. Now, I'm not suggesting that there's a univariate explanation that it's all about credit information. It's not. There are tax rates. There are restrictions on access to mortgage credit, for example, with a stress test. There's a lot of different variables that feed into this next one, but it's asset poor. Canada has the largest middle class among the OECD. Congratulations. But it's also a middle class that's asset poor. And 55% of Canadians couldn't survive 6 months without income. So there's not a lot of savings there. And again, it's not about credit information. There are many other things, but this is the context. So one can imagine it would be useful to have access to affordable credit to smooth over a cash flow disruption when life experiences happen, sudden unexpected job loss, sudden unexpected medical expenses, divorce, things like that, things that can tip people into bankruptcy otherwise. And so this is why, while the explanatory variable for the cause is not credit information sharing, data sharing actually can help mitigate some of the consequences of this and mitigate them. In essence, we looked at credit file data from TransUnion, and we appended it or matched it against StatCan data. These are two very large, different data assets that, and for preliminary research, we had to make a lot of data accommodations. But what we were hoping to show is who are the credit invisibles, how many are there, how does the TU data match against the census data, et cetera, to give us a first cut at, answering these questions. And there are data limitations. And I'm not going to dive too deeply into the weeds here, but for preliminary research, we can make accommodations. As we move forward to further develop instruments and research around this policy issue, we'll refine them. But neither of these data assets are perfect. I don't want to for a minute represent that StatCan data is perfect and limitations are on the private sector side. Probably the inverse is true. But these were data sets gathered for different purposes, applied to different functions, so it's not necessarily an apples to apples comparison. And I'm just saying this to be a responsible social scientist and call out the limitations. But even with that, we feel very strongly about the accuracy of our findings. And this is the first actual finding slide. So it was a really long build-up to these findings. So thank you for bearing with me. So this is the credit invisibility by province. And unfortunately for people sitting more than 4 feet away, it's the size of a postage stamp. But generally speaking, when we talk about credit invisibility, because we started this in 2004, 2005, the models at the time, the FICO probably was 6 or 7, excluded credit reports with fewer than 3 trade lines. And VantageScore didn't exist at the time. So if you didn't have 3 or more trade lines, the trade lines just account information, probably everyone in here knows that, payment history account information, but it's below header data, you weren't scored. And for most lenders, if you're unscorable, the default assumption is you're high risk and you're automatically rejected. So we consider credit invisibility. Now, you can have a credit file but not have trade line information. That could come from a hard inquiry. That could come from a public record. There are ways where you could be in a credit file database but not actually have a trade line. So there's the percentage with 0 trade lines by province ranges between 10 and on the low end to the upper bound of nearly 30%. So that's a lot, right? And now if we expand that to 1 or 2 trade lines, now again, current models, FICO 9, VantageScore 3, custom models at the different credit bureaus can score with a single trade line, even only 6 months of history. We haven't changed our definition to account for that, primarily because in most cases those are considered thin file models, and in most cases that's going to end up with a decision for a low credit level, typically with a higher interest rate. So there's still that implication that the less information suggests higher risk. And by the way, that's responsible. I mean, I don't know if you're the chief risk officer for a lending institution, how long you'd have your job if you were extending $50,000, $80,000 auto finance loans based on 6 months of data from one trade line from 5 years ago. Probably not very long. And by the way, that's actually what happened with the FICO XD back during actually the great financial crisis. FICO were telling people a 720 XD is a 720 Beacon or Empirica, and a very large auto lender in Canada was offering high-end auto loans on that basis, and that portfolio went south, and that person did get fired. So it's not just fiction. But what you see here is that basically between 1 in 5 and 1 in 3 persons in every province have fewer than 3 trade lines. So it's a huge portion. And by the way, sorry, let me correct that. Files. These are not people. These are files. And there are, again, this is sort of a data limitation issue. There are reasons why the number of files may overcount the people. There are some synthetic files or frag files. I can talk to you offline about this, but it's a rough proxy. So it suggests that, and this is, by the way, consistent with the findings in the U.S., but as a lender, as a fintech company, as a mainstream lender, there's an opportunity here to layer in more data and see a pretty significant population of borrowers differently and grow, sustainably grow across a whole portfolio of loans. So credit invisibility is actually an issue here in Canada. Everybody's just not strolling off the streets into the big five and getting whatever credit they want. So breaking it out a bit by sociodemographic variables. Consistent with findings in other countries, there are higher credit invisibility rates, meaning no trade line, 1 or 2 trade lines. It correlates fairly well with income bracket. So lower income has higher rates of credit invisibility, higher income, thicker files. In indigenous communities, and I want to be careful here. Again, it's preliminary research and not to read too much into this, but there's also a cultural aspect to this. There are communities, and this is also in immigrant communities, where credit is eschewed, that it's considered an activity to be avoided. There are communities that can function primarily on a cash basis. And I would suggest this is very prevalent in Asia, where we do quite a bit of work. Actually, in Japan, people will go and buy cars with pure cash. Take a briefcase or a sack of cash and buy a car, if you can believe it, even today. I actually bought jewelry for my wife at Mikimoto in Roppongi and Mori Towers. It's like the Beverly Hills of Tokyo. And I put a down payment, and they were customizing it, and I called when they said it was ready, and I couldn't pay with a credit card. They didn't accept credit cards. So I had to wire cash to a friend and have them pick it up and FedEx it to me. But so there are communities that just don't use a lot of credit, and this is one. And so in areas where you have higher concentrations of First Nations persons, Indigenous communities, Aboriginal, you have higher rates of credit invisibility. Similarly with immigrants, and for reasons that I just discussed. So, of course, these change. People adapt to their new country, their new host country. They become more amenable to credit. So, not to suggest that these aren't opportunities for lending. These are ripe opportunities for lending, but this is where the credit invisibles reside. Now, these next few slides are about credit deserts. And so we have actually put on, the red dots are fringe financial institutions. These are payday lenders and pawn shops. And the yellow areas are basically, if you see green, that means you've got less than 20% credit invisibility. Anything above that is 20, 30, 40, or 50. So there are actually some areas in Montreal where half of the people are credit invisible. So there are, there's large populations or large population segments where you have very little data to assess credit risk. Similarly in Manitoba, and here again, the FFIs concentrate around the population centers. The redder areas, it's distance, proximity to financial institutions, and also the community composition. Winnipeg, more narrowly, you see this. The FFIs correlate very nicely with high concentrations of credit invisibility. So we haven't layered on to this average credit score. We haven't layered on to this average income. That's part of the future research, but again, preliminarily, it's very telling. Edmonton, consistent again. So we're not seeing a lot of green, which is pretty surprising. But again, suggests the need for flooding more data in. The territories, this is a combination of everything. It's, lack of access, community culture on credit, et cetera. Not much population. But even Toronto, where we are, I don't know the sociodemographic geography of Toronto. I would assume there's clusters of new to credit around universities. I would assume, some of these strips are where there are lower income concentrations, members of protected classes, but there are, again, relatively high rates of credit invisibility in urban locations. So this is just not a rural issue. So future research. We need to do, obviously with the data limitations, we want to address some of those issues and get more accurate numbers. We think that ultimately the rate of credit invisibility will be reduced somewhat, but even if it were reduced by half, you're seeing areas that are above 50%, they're still going to be above 25%. We do believe that there, generally speaking, there will be some reduction in credit invisibility, but not by huge margins or multiple deviations. We'd like to do better sociodemographic analysis. We'd like to sort of drill down into some of the cruder metrics and understand better who are the affected populations and what are the specific challenges that they confront. And then, sort of adding these additional variables, the average household income, average credit score, et cetera, to the different geographies we think could lend quite a bit of color and flavor, as well as the additional fringe financial institutions and mainstream lenders. And then finally, we want to have that solution slide. We want to show what happens to these areas when we have alternative data, when we have different solutions that might come from open banking in Canada, that might come from data-empowered fintech companies who have solutions, that might come from a data mandate where non-financial payment data is fully reported to credit bureaus. So for the record, we've consistently advocated that comprehensive full file data be flowed through credit bureaus. And the reason being is that for us, a credit report offers consumer protections. A credit report is an instrument that's designed specifically to affect individual decision making. People understand the carrot and the stick, that if I pay my bills on time, I can improve my credit limit, I can improve the terms which I'm offered, I can access more and different types of credit, and if I don't, then I can't. That's less true where data is residing in a lot of different fiefdoms and silos. People are unaware of them. If they don't know this data is available to them, if they don't know this data is consequential, it doesn't have the effect on their behavior. So while I do think that the market is coming up with creative solutions, particularly in countries where they've encouraged more data flows through open banking, I still think that the consumer is the linchpin, and there needs to be communications and education, financial literacy that help them understand this. But the tried and true method that there's very broad, well-established awareness of right now is a credit report. So what are the policy implications? We would advocate mandating data flowing. We see that where there's an undersupply of data, and given the credit deserts, there's an undersupply of data. If the market hasn't acted, it's a market failure, and there's a justification for strategic government intervention. I believe that to be true in the United States. I believe that the lenders now will support this because they don't, even though we call it a voluntary system, it's actually a de facto mandatory reporting system for regulated lenders. It's not a de jure, but it's a de facto. And lenders think it unfair that they have to freely provide their data, but these non-financial institutions don't. And the non-financial institutions get to see details of their customers and not vice versa. And it's becoming increasingly tenuous for mobile network operators to suggest they're not creditors when they just introduced $150 billion of new credit in handsets last year alone. They are creditors. And under ACOA, it is considered credit. So there's a growth of realization that the government needs to do something. And it's a similar situation here in Canada. MNOs and others are lending lots of money. They're not regulated the same way. They're not reporting, yet they access the bank data the same way. So this one, I know Matt wasn't real happy when I said promote competition in credit reporting. I'm not suggesting that they need to set up a third nationwide credit bureau. This is about open banking. This is about creative solutions to access the data, to bring it to the market where there's a market failure. And there's been some terrific examples of this in fintech in other countries, and certainly that can hold true in Canada. And then finally, there's just a mindset change that's needed. There's a lot of education that's needed in Ottawa, where right now, particularly in the wake of sort of big data breaches and all the sensationalized media coverage, and we call this the Jaws effect, where data breach happens and there's massive media coverage and everyone's told you're at immediate risk and you're at risk for the rest of your life. But if you actually look at the data, the probability of suffering from any form of identity fraud or theft from breach-affected populations is actually less than the general population. It's sort of people go to beaches and they all think they're going to be attacked by a shark, but only 2 people out of hundreds and hundreds of millions of swims are killed by shark bites in the U.S. or Canada. So it's just there's no there. But lawmakers nonetheless respond to that media sensationalized, induced fear. They pass data restrictions, and it's hard to access a lot of this data. So in part, working toward open banking is part of this, but there needs to be more of a push to get regulators to embrace data and data sharing and understand that data is the solution, it's not the problem. So with that, I'll thank you for your attention. I have no idea how I did on time in 45 minutes. I'm probably way over, or maybe I'm right on. But appreciate your attention. Thank you for coming, given the climate, and I look forward to your questions, which I would suggest, Tal, do we hold them to the end? Or? That'd be great. Okay, hold them to the end, because we have a lot of great panelists who have very different perspectives on this exciting topic, and I want you to hear from them. So thank you.